Welcome to the final part of Chapter 4. Finally, we're almost done. This will be a quick lesson. Because merchandisers have a few more accounts than do retailers, they also have additional adjusting and closing entries at the end of the period. Also, we'll take another look at the multiple step income statement and learn how to calculate the gross margin ratio. Now, adjusting entries are generally the same for merchandising companies and service companies, including those entries for prepaid expenses like depreciation, accrued expenses, unearned revenue, and accrued revenues. We learned about these in Chapter 3. However, a merchandiser using a perpetual inventory system is usually required to make another adjustment to update the merchandise inventory account to reflect any loss of merchandise, and this includes theft, obsolescence, and deterioration. Shrinkage is the term used to refer to the loss of inventory, and it is computed by comparing a physical count of the inventory with amounts recorded on the books. And a physical count is usually performed at least once annually. That's at a minimum. Some companies perform them monthly or more frequently if they have a lot of transactions. The coffee company performed them at a minimum quarterly or more frequently if we had problems. A physical count, then, is an important internal control right over merchandise inventory. To illustrate here, for example, let's assume Zmart's merchandise inventory account at the end of the year 2015 has a balance of $21,250 in the books, but a physical count, that means they went out into the warehouse and counted the inventory, reveals that only 21,000 of inventory exists. The adjusting entry to record the $250 shrinkage is a debit to cost of goods sold and a credit to merchandise inventory for $250. Then moving on, closing entries are also similar for service companies and for merchandising companies using a perpetual inventory system. The difference is we must close some temporary accounts, new ones, that arise from merchandising activities, including the sales account, sales discount, sales returns and allowances, and cost of goods sold. So your textbook describes the closing entries in detail, and please do go and review those on your own. And you should be familiar then with the next steps in the close process. After all the adjusting entries are made and adjusted trial balance is prepared, from that we prepare financial statements. Let's take a look once more at the multiple step income statement commonly used by retailers, wholesalers, and manufacturers. Generally accepted accounting principles don't require companies to use any one particular presentation format for financial statements, so we see in practice many different formats. A multiple step income statement format, though, shows computation of net sales and other costs and expenses, and it reports subtotals for various classes of items. The statement itself has three main parts. First of all, gross profit, which is determined by net sales less cost of goods sold. And then secondly, income from operations, which is determined by gross profit less operating expenses. And third, net income, determined by income from operations adjusted for non-operating items. Okay, so non-operating activities include of these other expenses, revenues, losses, and gains that are not really related to a company's operations. In the income statement that is shown on the slide and in your textbook, non-operating items have been excluded in the interest of readability. Now, operating expenses, on the other hand, are classified primarily into two sections. Selling expenses include the expenses of promoting sales by either displaying or advertising the inventory, the merchandise inventory. They include making sales and delivering goods to customers. And general and administrative expenses support a company's overall function and include expenses related to people like me, right? Accounting, human resource management, financial management, and the executive office. So refer to your textbook, please. I think it's Exhibit 4.13 to see a multiple step income statement in much more detail. And finally, the gross margin ratio is the last subject I'd like to discuss with you. The multiple step income statement permits us to calculate this very important ratio. Now recall that net sales minus cost of goods sold equals gross profit, which is also known in some circles as gross margin. The gross margin ratio, often also called the gross profit ratio, is defined as gross margin divided by net sales. The cost of goods sold usually makes up much of a merchandiser's expenses, so gross profit must be large enough to pay for a company's operating expenses if the company is to remain in business. Users of the financial statements then often compute the gross margin ratio to help evaluate how well a company is able to manage both the sales price for its product and the merchandise's cost. In most cases, the higher the gross margin, the better off the company is. So great job. Excellent work getting through Chapter 4. Hopefully you found that there are some real-world applications for the topics we covered. Have a really great rest of your week, and please let me know how it's going. Take care. Talk to you soon.